Yeah, I generally recommend people that either use the doctors a lot or very little. The high deductible health plan with the HSA is the best choice. The people that are kind of in between are the ones that might be better served by not using the HSA and the high deductible plan.
And it all just depends on, like, okay, I'm assuming this is what my expenses will be. You run the numbers on it and you just go from there, right? We can't tell you one way or the other unless we were looking at your exact numbers and your exact plan.
Yeah.
Welcome to the Teacher Money Show, the podcast dedicated to helping teachers navigate your unique financial challenges and unlock your financial superpowers. I'm your host, Shaun Morgan, a full-time educator and personal financial coach and speaker. And I'm here to help every teacher, whether you are a seasoned teacher looking for fresh insights or a new educator navigating your first paycheck, to have a richer wallet, classroom, and life. I'm super excited to have Jeff Venables back on the show today. Jeff, as you may remember, is a financial planner and full-time teacher. He is teaching science and personal finance full-time, as well as helping teachers with their personal finances. So, Jeff, welcome to the show.
Thank you for having me back, Shaun.
So, Jeff, you recently sent out an email that I thought was very timely, and I was like, oh yeah, we should probably talk about that, all about open enrollment. So let's just start off with that. What is open enrollment, and why is that an important time for us to pay attention?
Well, open enrollment is your opportunity every year to check on your benefits and your insurance coverages and all of the, other related benefits that come along with the job. And at least where I am, it happens every year in October and November, and it's your making all of your selections for the next year. So we're all now making our selections for 2026.
Yeah, awesome. So if you're Canadian, you're like, what on earth are you talking about? It's because it's an American problem where we just, have to choose our insurance every single year. But that's what we're talking about. Every single year, you got to choose your insurance, choose other benefits. How much do you want? What kind of coverage do you want, etc. So that's what we're looking into. So the first thing, the main purpose behind open enrollment is your health insurance, choosing your health insurance plan. So what do we do to make sure we have the right coverage? What are some common mistakes people make when choosing between these, acronyms, HMOs, PPOs, and HSAs, and so forth?
Well, the first thing you need to know is what your medical needs are. And so you can choose the plan that best fits what your needs are. In my school district, we don't have HMO available to us. So we just have two different PPOs. But HMOs are your lower premium plans generally that give you more preventive care. And then your PPOs are by the way, HMO stands for a health maintenance organization. So you choose a primary care physician, and then anytime you want to see anyone other than your primary care physician, you have to get a referral from that primary care physician. So the primary care physician directs all of your medical care, and they point you to your specialists. Your PPO, you have a lot more flexibility. You can choose all of your own doctors. You don't need referrals. You can go straight to your specialists. Most of the time, these are a little bit more expensive for that reason. At least where I am, these offer less preventive care. They're more about treating you once you're sick. So again, where I live in South Carolina, we just have two different PPOs. We have the regular one, and then we have the high deductible one, which is the one that I generally choose. And so when you're choosing between whether you want the regular plan or the high deductible plan, that's where you need to really know. Obviously, you need to be able to predict the future. But if you can't predict the future, you need to reasonably guess whether you will be better served by a high deductible plan or a regular plan, standard plan.
And if you have the high deductible plan, you most likely have access to an HSA, correct?
That would be the reason for having a high deductible plan in my estimation, is so that you can then take advantage of the HSA, correct? So you have to have, there has to be a high deductible plan in order for you to have a health savings account.
Yeah. So the high deductible is like really subjective. I think it's like $2,500 or something like that, which sounds like a low deductible to me with my plan, which is like $6,000 or something like that. So it depends entirely on your plan. But yeah, the HSA option requires that high deductible, and it's embedded within another type of plan, right? It's not like a separate thing. It's just like if it's a high deductible, therefore you qualify for an HSA.
Correct.
And even if, just throwing this out here, even if you uh, do anticipate getting sick a lot, you're like, oh, I should probably choose the higher premium one so that way I'm more covered than the HSA version. I did a whole episode giving a scenario where the HSA actually makes more sense, even if that is you. So make sure you listen to that episode. You can go to teachyourmoneyshow.com/podcast or the link in the description directly in the podcast player to get to that. And it will just break down how to calculate whether or not you want the HSA, even if you hit your out-of-pocket maximum. And if that number is really close, then the HSA plan probably makes more sense because the likelihood of hitting your out-of-pocket maximum is pretty low. So just do those numbers before deciding one or the other.
Yeah, I generally recommend people that either use the doctors a lot or very little. The high deductible health plan with the HSA is their best choice. The people that are kind of in between are the ones that might be better served by not using the HSA and the high deductible plan.
And it all just depends on, like, okay, I'm assuming this is what my expenses will be. You run the numbers on it and you just go from there, right? We can't tell you one way or the other unless we were looking at your exact numbers and your exact
Correct. Yeah.
plan. And each plan is so ridiculously different. Like it just there's no way to give you a golden rule on that one. But HSAs are pretty darn sweet. So highly recommend them.
So do I.
So we've reviewed our health insurance. We made sure that we are getting the exact coverage that we need. And then there's these other things that are health but not health, which are your dental and vision plans. Are these things actually worth it? How do you evaluate them compared to like health insurance? Like you have to have it, but like, do you have to have dental? Do you have to have vision? How do you figure that out? What does that look like?
Kind of the same thing. You need to know what are your needs. So for the longest time, I never had a vision plan because I never needed one until I did. And then the vision plan is generally so cheap that if you know you're going to need glasses or you know you're going to need contacts, it's probably worth getting that because it pays for itself. Um, as far as dental goes, you have to really look into that. You have to look at the dentist that you go to. If your dentist is not in network, you're not going to get much coverage usually out of a dental plan anyway, and so it's not always worth it. So that's, again, you need to research what the costs are with and without insurance, which can be a challenge, and then decide whether the amount that you're going to pay for the insurance makes it worthwhile, and then hope that you don't have a catastrophe.
Yeah, so you can go back to like if you had dental bills before, they're required to be able to give you an itemized bill, so you can like go through and look. So, okay, this is how much would it cost without insurance. This is how much it would cost with insurance. How much am I paying for insurance? Do I anticipate using that again? Also, if you pay out of cash, you might be able to get them to give you some wiggle room, even though they say this is what you'll pay. So, like, there is some of that finagling that can happen with doctors. So, it's a real thing to consider for the dental plan. And if you don't need dental work, bless you. Keep brushing your teeth, people. It's dental work gets expensive really fast, and dental insurance is not great. They cover some things, but like it's a pretty what's the word? They hold their money close to their chest on dental plans, and so just be aware of that, especially because like most dental procedures aren't like life-threatening, so they can like make the case like this wasn't medically necessary, and I had to go through that whole rigmarole with my dental insurance plan. So just keep that in mind.
The other thing to keep in mind is sometimes if you've got kids that are coming up upon braces, some dental plans will cover a certain amount towards braces, which will make the plan worthwhile.
Yeah, that I hadn't even thought about braces. So hopefully I don't have to think about braces for a while. And then you mentioned that vision plans kind of pay for themselves. This is totally off topic, but do you even know how they make money? Because it doesn't make any sense to me how like I can pay like $7 a month and then they can give me like, $100 and something off of my glasses. It's like, they seem to be losing money on that proposition unless they have like a major connection with the companies. Just out of
My
curiosity.
guess, the best guess that I can give is that it's really just a negotiated rate where they, by being part of that plan, that the providers then provide a discount off of their services.
Yeah. So I was looking into that. I'm like, do I really need vision insurance? And it's only a little bit a month, but I'm like, how much do they really save me? And then like they cut my glasses cost in half. And I was like, well, save me some good money there. So uh, just something interesting. It's probably worth it if you're going to need to get an exam every single year and buy contacts and so on and so forth to have that vision plan.
Agreed.
So the next one that usually pops up is life insurance. And of course, most teachers are given like $25,000, something like that, just for free for working for a company. Uh, but then they offer you supplemental. So how do you find out what you really need for life insurance? Should you go with the supplemental? Should you go with private? How do you figure that out?
You have to shop around. So, yes, first of all, you need to evaluate what your needs are. You need to figure out, okay, how much life insurance do I need? There's several different ways that people do that. Calculating the value of someone's life is not an easy thing to do. But it's basically how much money would your family need to replace you if you were lost, as far as what your income would be. And so, you know, there's several different methods that people use to calculate it. A very simple thing is sometimes people will say 12 times your annual salary is what you should aim for. That's not a one size fits all answer. But it's a good place to aim as far as how much life insurance do I need. Again, it depends. How many people are dependent on your salary and how many more years do you have left to work. I don't have that many years left teaching, so my life insurance needs have gone down. I'm nearly self-insured anyway with my retirement investments. So all of those things come into play. How much money do you already have saved up? If you've got enough saved up, then you probably need less life insurance. And then when it comes down to, do you take what's provided by your employer versus do you go private? Part of it depends on your health, because your employer provided insurance is usually group insurance. And so if you're in poor health and you're difficult to insure, then the group insurance is a good way to go. If you're in really good health and you're going to pass the medical exam and you're going to qualify for the best rates for private term life insurance, then you go with the private term life insurance, or a combination of the two. That's what I have. I have the free insurance that my school district offers, a little bit of the group insurance, and then I have private term life also.
Yeah. And it all just depends on what you can get. Now, the thing to keep in mind is that if you move jobs, you no longer have that group rate, and you're going to have to get it again. And you could have a different health at that point. Well, if you have private insurance, you just have it as long as the term lasts, right? So that is
Good
something
point.
definitely to consider when weighing the two. And of course, I don't think you're even allowed to opt out of it, but like take the free insurance if you're like do it. Like
Always. Yes.
don't skip that piece.
There's no reason not to take the free insurance.
Yeah. And then if you're like a new teacher with no spouse and no kids, you do not need anything because if you die, no one depends upon your income. So like that would be that's one of my biggest problems with like these people that come in to sell like products to teachers is they'll sell a brand new teacher whole life insurance policy, which makes no sense because you don't need life insurance yet. Like you don't have anyone that depends on you. So it'd be much better to be self-insuring by putting money into your investments so that they'll grow. And then, if you end up with a spouse or dependents, then you can get life insurance to balance that while you haven't grown it yet. But then, as Jeff was saying, once it grows, you can just have yourself self-insured because you don't have anyone depending on your income or as not as much, or you have your investments bringing in so much money that you don't need income anymore. So therefore, why would you need life insurance? So that's the range. You can go from no life insurance because I'm too poor and don't have anything going on to I need a lot of life insurance to now I don't need it again. It's the whole pendulum swing.
Yes, and you mentioned whole life insurance. Most people don't need whole life insurance. Most people should opt for term life. because you're just buying insurance. You don't need cash value insurance. Some people do. There's very specific situations where it makes sense, but for most of us, term life is what you should go with, the cheap stuff.
If anyone like tells you, oh, you should get whole life insurance because it's an investment, uh, the thing that just blows my mind is that they're saying it's good investment. It's like, well, you know what's going to happen when you give your money to the whole life insurance company? They're going to turn around and invest it in the stock market. So why don't you just invest in the stock market yourself? That's my way of thinking about it.
Yeah, because otherwise they're going to keep part of your gains.
Yeah, absolutely. So that's the anyway. I could bag on whole life insurance for a while, but let's move past that. We figured it out. Once again, our cop-out answer on all these is run the numbers yourself because we don't know your situation. But yeah, it's important to just kind of build this checklist of what are the things that I'm looking at as I am going through open enrollment. So the next one
Another
that usually
thing,
pops
while
up.
you're talking about life insurance, is don't forget to make sure that that your beneficiaries are who you want them to be. If there's been any changes in your life, I've been through this. If you drop a spouse, maybe pick up a new one, make sure you update your beneficiaries.
That is very true. I've heard stories of people whose ex get their money because they didn't update their beneficiaries, and that's probably not what you want. Or if you've, had another child and you didn't add them, they're not getting any of that money, right? Necessarily. So just make sure you're updating that, checking that once a year. That's what this time is for, is to be like, hey, what do I need to do?
This is a great opportunity to do that. Yeah, to check on all of those.
Yeah, so the next one that pops up is usually disability insurance. Do we even need that? Why, like, is if it's optional, I mean, if it's there, of course, just take it. But like, if it's optional, do you need it? Do we need supplemental on that more? Is there private options? What do you think?
So once again, it depends. It really depends on whether you have an emergency fund. If you have a fully funded emergency fund and you can weather the storm of a disability or being out of work for 3 to 6 months, then you probably don't need it. Most people don't need short-term disability at all, but I oftentimes do recommend a long-term disability policy for people, so that you can have a replacement of your income if you should be unable to work for a long period of time. But usually those don't kick in for at least 90 days. So you need to have your 90 days, your 3 months of emergency fund to fund you over until the long-term disability would kick in.
Yeah, that's a good point. That the disability is unimportant for the short term if you have money to cover that time period. But long term, unless you are independently wealthy at this point, you would need to have some form of long-term disability just to cover you if you got in a car accident and can no longer work or something like that. Once again, just like life insurance, this is one of those things that goes down the more money you have invested. So, this is a time to check, like, do I need that much disability insurance anymore? Maybe you can adjust your policy amount or things like that. It just depends on, what you're doing. So that's a good point.
Absolutely.
Okay, so another couple of things we want to, just kind of check on during this time. And we probably should have talked about this earlier, but we have these flexible spending accounts that pop up, and you talked about in this email I mentioned that they're powerful but dangerous, really. So, would you recommend even using a flexible spending account in your health insurance, or what are your thoughts on that?
So my answer to that is yes. Again, it depends, but yes. Especially, well, dependent care is an easier one because if you're going to have daycare costs or whatever with the little ones, and so it's a lot easier to estimate how much that's going to be to make sure you're going to use it up. As far as the healthcare flexible spending account, my recommendation is always go low on that one. If you're going to, you're going to spend some money on healthcare during the year on deductibles and co-pays and that sort of thing. And of course, they've opened back up again what some of the over-the-counter things that you can buy with FSA dollars. So yes, you can still use those because you're putting pre-tax money in there, so you're saving. You're sheltering it a little bit from taxes. But you don't want to go high on that, because you use it or lose it.
Which just bothers me. I don't use flexible spending accounts just out of principle because it bothers me that they do that. Like that's just obnoxious.
Yeah, I understand. And so interestingly, so I love HSAs, and I'm a huge fan of the HSA, and I was late on the HSA train, but um, essentially the HSA, people say triple tax advantage. It's actually quadruple tax advantage if you have it taken out of your paycheck, because not only does it go in pre-tax, but it also goes in pre-payroll tax. So you're not even paying Social Security and Medicare taxes on what you put into the HSA, nor are you paying income tax. And if you're saving the receipts, then you withdraw all the money tax free at the end. So it's like a a traditional upfront and a Roth at the end, and I love that. You can also, with that, have a specialized flexible spending account, which is only for dental and vision expenses. So if you know there's going to be some dental and vision expenses, you can also do a flexible spending account to cover those. So the way I use my HSA is I invest the max into my HSA, and every time I have an out-of-pocket expense, I pay it out of pocket. And my HSA is just an extra retirement investment account, but I'm saving all the receipts. And so in retirement, when I want some tax-free money, I can take it out of my Roth, or I can take it out of my HSA, and I can just submit some receipts for that.
Yeah, I love that. Okay. I could say many, many good things about the HSA, but I have, 2 whole episodes on it, so just check those out.
I wished I had jumped on that train sooner. That's all I got to say about that.
Oh yeah, it's a great train to be on, especially because like in the event of a medical emergency, it can act as an emergency fund for your medical if you actually need that, right? So it's just got so many different advantages to having that HSA. Because worst case scenario, it turns into a traditional retirement account. Like
Right.
why anyone would choose to fund a traditional retirement account over an HSA doesn't make any sense to me, because an HSA just turns into one of those with all these other benefits built in. So that's my
Agreed.
2 cents on that.
You're not wrong about that.
And speaking of retirement accounts, even though you can enroll in retirement accounts at any time, uh, would you mentioned like using this time to check in on those? Uh, what does checking in on like a 403B, a 457, or even an IRA look like during open enrollment?
Well, just check and make sure. Number one, going back to the life insurance thing, check on your beneficiaries, because all those accounts have beneficiaries. Make sure that those are up to date. But also, the limits go up from time to time. Make sure that if you're trying to increase, if you're trying to contribute up to the limit, make sure you're meeting the limits. If it goes up from when, I remember when I first opened my first IRA, the limit was $2,000 a year, and now it's $7,000. So, actually for me, it's $8,000. So, cause I'm an old guy. So, you pay attention to the limits, and, pay attention to your age too. If you happen to hit the magical age where all the limits go up, there's a lot of increases that you can put into your IRA, into your 403B, and to your 457. So it's getting to the point where you can, you can put a lot of money in there. So check them, and also do the analysis. Is this the time for me to switch from a traditional to a Roth, or from a Roth to a traditional? Based on what your income is and your tax brackets, it's a good opportunity to do a little tax planning as well, and see, okay, is now the time for me to put a little bit into a traditional account to push myself back down into that lower bracket, keep myself from paying 22% on, those last few dollars.
That is an excellent point. All right, so we've mentioned this financial health checkup thing a couple of times. Is there anything else that you would recommend someone checks into during this time, besides all these insurance things and their retirement accounts?
Well, with the insurance things, there's all those optional insurance policies that they try to sell you. Be careful with those. A lot of those are redundant type policies, and I generally avoid those, and I recommend avoiding those. So again, it depends on your situation. If you know that you've got a lot of cancer history in your family, and then maybe you want a cancer policy. But usually, your healthcare policy is going to cover cancer treatments. So no, those are the main things that, this is a good opportunity to just think about all of the things in your financial life and in your insurance life. A lot of people don't think of insurance as their, it's like a whole separate thing, but it's really the way that you protect all the wealth that you work so hard to build. So make sure you have all the insurance that you need. So, well, honestly, why not during this time of year, while you're thinking of these things, shop around your homeowners or shop around your auto insurance as well. One thing I'll say about insurance companies, I don't hate insurance companies, but insurance companies are notorious for taking advantage of, like the cell phone companies, they take advantage of your loyalty, and they actually raise the prices on people that are loyal to them. And so what they do is they encourage you to shop around. So shop around, you find an independent insurance agent, shop around your car policies, shop around your homeowners policy, and see if you can get a deal.
Yeah, I love it. And something else that pops in my head is, if you're trying to figure out when you're going to do that rebalance of your portfolio annually or maybe semi-annually, this could be a great time to do that portfolio rebalancing.
Yeah, that's a good point. I always do it on my birthday, but yeah, open enrollment's a good time to do it too.
If you just like, I don't know when to do it, just random time. Well, this is a good time if you're doing all the, box checking, just like, I'm just going to go right through here and check all these things off, including my rebalancing. This could be that time. Like, and I love the idea of just choosing a random time, right? I love how you celebrate your birthday by rebalancing your portfolio. That's, slice the birthday cake and, rebalance my portfolio. But, it's just choosing a random time. The new year is a bad time to do it. It's just craziness always happening around then. But pretty much any other time, it's just kind of random. So that way you're just checking in on it. And this would be a good time to do that if you have not done so already. Or if you just want to get in a rhythm, you can probably do your check now and then, go into it. And we just did an episode on credit score. Like you can add, start your credit check, as we recommend doing every 4 months. So you can hit one bureau every 4 months over the course of a year. Like there's all sorts of things you can do to just like start your clock on your financial check-ins around this time. So that way it's all happening at once.
Great point.
All right. Well, I mean, we just wanted to do a quick hit on this because, next week we're getting into open enrollment. I want to make sure everyone is thinking about it and then not just going to go through and click all the buttons, but actually, pause and ask, is this what I need? But that's kind of it. Is there anything else that you wanted to bring up before we wrap up with the last two questions of the show?
Nope. I've enjoyed talking to you again.
Yeah, I love this. This is a nice, quick. We got through a bunch of information. Hopefully, this was really helpful to everyone listening. So my last two questions I ask all my guests are: first, if a teacher would like to ask you some more questions about this or another topic, how can they get in contact with you?
The easiest way is venablesfinancialsolutions.com. That's where they can find me, and you can just click on there, and I'll give you 30 minutes for free, and I won't try to sell you anything.
That is quite the promise. Won't try to sell you anything because anyone else who's giving you time for free is probably trying to sell you something. So, just help you out. And then if you'd like to keep working with him, keep working with Jeff. That's how it goes. All right. The last question then, Jeff, is, maybe you can remember what you said last time. So try and say something different. What is your number one tip for teachers to have a richer wallet, classroom, and life?
Well, fortunately, I don't remember what I said last time. So my number one tip would be to the very last thing that we talked about. Make sure you focus on those retirement accounts and make sure that you pay close attention to whether you want the, there's a lot of people early in your career, Roth is the way to go while you're in the low tax brackets. But, when you start earning the big bucks and you're pushing yourself into another tax bracket, it may be time to consider switching over to a traditional account and putting some money in pre-tax to lower your taxes now. So I would say, don't forget to do some tax planning along the way.
I love it. Don't forget tax planning along the way. That's a great way to put it. I don't believe that's what you said last time, but we'll have to go back and check to see if your number one tip is consistent or not. Well, Jeff, thank you for coming on the show. This has been a lot of fun.
Thanks again, Shaun. I've enjoyed being here.
Wow. Wasn't that episode a ton of fun? Thank you, Jeff, for coming on and sharing your thoughts about open enrollment. Now, hopefully, we didn't get to you too late and that you still have open enrollment. But if not, you can make your checklist for next year because open enrollment will come back around again next year, just like clockwork. But here are my top takeaways, my cliff notes for this episode. Number one, choose what best fits your needs. Don't get just anything that's offered or just, choose at random. Make sure you're checking your actual needs. Number two, do your own research for your situation. You can't just take someone else's "you should do this" scenario, right? I would tell you that you should probably do an HSA, but there are situations where you should not do an HSA. So don't just say, well, Shaun said HSAs are great, therefore I'm going to do an HSA. No, that's not what I said. Do your own research, check your numbers, make sure it makes sense. Number three, take this time as a time to check in. This is the time to do your whole checklist. We've gone over this a few times now, but make sure you're checking off, you've done all of your insurance checks, you've gone through your retirement accounts, anything else that you need to check on in your financial life right now, this is the time to do it. Number four, as part of that, make sure you are checking your beneficiaries. This is huge. I just had my son born this year, and I went through and I added him as a beneficiary to all of my accounts to make sure that he's not left out if something were to happen to me. So that is a very important thing to always update that. So that way you're not giving money to people that you don't want to give money to, or you're not leaving somebody out that you do want to give money to. And then number five, adjust your insurance amounts and your retirement contributions to meet the limits. So that way you are not paying for more than you need and you are contributing as much as you would like for retirement. Those are my top 5 takeaways. Once again, if you would like to get this information in the show notes, especially if you'd like to check out the HSA episode, I've done 2 of them. I did an episode on disability insurance as well. You can go to teachermoneyshow.com/podcasts or go to the link directly in your podcast player to find all the information there, as well as information on how to contact Jeff. And as we're wrapping up, I would just like to ask, please share this podcast with a teacher friend of yours, because the more people that know about this, the more we're going to be able to grow as a profession as we focus on our finances and grow wealth and make the world a better place. But even if you haven't started growing your wealth yet, if you're just slowly moving along, remember that as a teacher, you are already rich. Your wallet just needs to catch up.
If you would like help on your personal financial situation, go to teachermoneyshow.com/coaching and you'll be able to find different ways I can help you there. If you would like to participate in spreading this message of financial empowerment to teachers, I would encourage you to talk to your administrator or to your district level about going to ShaunKMorgan.com to find more information there. And regardless of which one of those you need, please like and subscribe so that way we can spread the reach of this more. Leave a 5-star rating and review. That's going to help more teachers find this. And then turn around and tell a teacher friend. I really appreciate it.
The contents of this podcast are informational in nature and are not legal or tax advice, and neither I nor my guests are engaged in the provision of legal, tax, or any other advice. You should not act upon this information without first seeking appropriate advice from an accountant, financial planner, lawyer, or other professional.